investors, if you're looking for stocks that go up, 500%, 1,000% or more, that's right, I'm talking about 10 baggers. Listen up. My name is Jack Marks, and I literally wrote the book on 10 bagger stocks. In case you don't know, a 10 bagger, it's a Wall Street term. That means stocks that go up 1,000% or more. The name of the book is 10 Bagger Blueprint. You can get this on Amazon. I want to share with you something very important, which a lot of investors that are smart pay attention to. And the amateurs ignore this at your own peril, or you kind of scoff at this. I'm talking about stock promotion. Why is stock promotion so important for microcap stocks? Well, here's the thing. If a tree falls in the forest, imagine that tree, if it was in a forest, it falls in the forest and nobody hears it. Did it make a sound? No, it did not. Well, here's the thing. In order for a stock to get to increase in price, or in order for a stock to go up, you need to have demand. You need to have demand for that stock. And the only way to have demand for that stock is if people know about it. Does that make sense to you? I mean, it should be pretty logical, right? The more people know about a stock, the more people know about a stock's upside potential, the more potential demand there can be, right? Now, this is why stock promotion is so important. Now, the CEOs who are smart, the guys who I call the 100x CEOs, those CEOs that, have the qualities, to build stocks that become, 10 baggers and potentially even 100 baggers. And you know what? Look, nobody on Wall Street has introduced investors to more stocks that have increased 1,000% or more than yours truly. I've had a couple of 100 baggers also. And you know what? The guys who are smart, the CEOs who are smart, they have a major focus on promotion. Why is that? Well, you know what? As I talk about in my book, 10 Bagger Blueprint, and as I explain to CEOs in our 100x CEO seminars, the stock is the tail. The stock is the tail that wags the dog. You know what that means? Well, here's the thing. If you have a stock that goes up from, let's call it 25 cents to $2, right? It increases 1,000%. The valuation of the company increases from, let's call it 10 million to 100 million. All of a sudden, that company, no matter what the fundamentals are, but once the valuation increases from 10 million to 100 million, that's $90 million in extra. It's basically capital, right? They could use that. They can use that stock to make acquisitions, M&A. They can also raise capital without dilution. See, the big problem is for most of these companies, they constantly have to raise money. I'm sure you know that, right? The big issue is, investors talk about this concept of dilution. Well, dilution doesn't matter if your stock is increasing, because if your stock goes up, it's even 500%, 300%, whatever that is, right? That means your cost of capital has decreased by, 90%, 75%, right? So, the more your stock goes up, the more liquid it is, the cheaper it is to raise capital without having that dilution, which is what kills stocks. At the same time, when you have a high-flying stock, all of a sudden you can make acquisitions. So let's say you had a stock which was 10 cents. The market cap was only $10 million. You can't really do anything with that, right? But let's say that stock all of a sudden goes to $1. Now you got $100 million valuation. Now you can actually buy a real business for $50 million that generates, 25-50 million in revenues, and all of a sudden you can actually you can build on that. You can pyramid on that. And we've seen countless stocks, countless companies that they started with absolutely nothing, and all of a sudden they built it into a major business as a result of the price. Now, I'll give you an example. One of our clients, ESE Entertainment, we introduced that stock at, I think it was 17 cents. It went to, I believe, it was 37 cents, 37 cents. It went to about $4 or $4.50, whatever it is. It increased 1,200%. As a result of that, that CEO was able to do a whole bunch of acquisitions that took their revenues, their run rate from basically zero. They had almost no business. There was basically a concept when we introduced that company. And it went to about 100 million in revenues. That's right. The guy went from zero to 100 million in revenues purely as a result of stock promotion. Now, of course, what happens with some of these guys who are amateurs, like this guy from ESE, his name is Conrad, he thought he was a genius, and he didn't need to do any promotion after the stock increased. He thought he didn't need Wall Street Reporter, my company, And as a result, his stock, he stopped promoting the stock. And as of today, the stock is 7 cents. That's right. It went from $4 to 7 cents. Why is that? Because he stopped promoting that stock. You know what else you need to know? In a bear market, and we've been in a bear market for the last 2 years, 3 years, possibly, right? I'm doing this video in November of 2023. A lot of stocks peaked in February of 2021. So we've been in a bear market for almost 3 years now. And the guys who have been consistent in the promotion and engagement with investors, look, most stocks did go down, but the guys who were promoting, their stocks went down a lot less. I'll give you an example. A stock called Nexttech, another one of our clients. When we were promoting that stock, it originally went from 50 cents to $7.50. Okay, we were done at that point, increased 1,200%. Yeah, I didn't think we could do any more. And we basically said, hey, that's it. You guys are on your own. I mean, good luck. And then, the stock, unfortunately, came down because they didn't have the right promotion without Wall Street Reporter, without my company in place. And it went down to about 75 cents or 50 cents. I think it was 50 cents, 60 cents. We came in, we got involved again, and the stock, and this is in the middle of the worst bear market, and that stock went back to $1. The last we were involved with it was $1.25. Okay, it went to $1.25. So basically doubled in the middle of a bear market where most stocks were down 75% or more. This stock doubled, okay, as a result of promotion. They were able to raise capital, of course, at higher prices. And you know what happened when they, again, that CEO for whatever reason decided didn't need that promotion anymore. That's fine. And once we stopped, that stock went from $1.20. It's today 12 cents, 10 cents maybe, right? So that tells you the value of promotion, because again, this guy's using all sorts of other, marketing tools, all sorts of other stock promotion companies, investor relations, whatever. This guy's spending $1 million a year probably, right? And this guy's one of the best in the game. The CEO of Nexttech, Evan, one of the best in the game. But without Wall Street Reporter, without my company, which is, I'm not trying to brag here, but I'm just telling you the facts. We've been in business 25 years. It's a brand that goes back to 1843. I have a whole bunch of videos that explain why we are the best at what we do, but it explains to you really the value of that promotion, because it's not just in a bull market. In a bear market, this thing keeps stocks. It's like an insurance. It's an insurance policy. So if you're a smart CEO, you understand the value of this. It's important to keep your stock price stable or increasing, and that's the value of promotion. Now, if you guys don't understand, if you think promotion is just a waste of time, if you think it's just you call it a pump and dump, whatever you want to call it, that you think it's just hype, that's not true at all. The value of what promotion really is getting a massive amount of eyeballs on a stock, helping a company explain their story in the best possible way. That's what we do. Okay, we have a massive number of eyeballs that we're able to bring to a stock. We're able to scale the number of eyeballs looking at that stock, which nobody else can do. That's really the secret of our success. And of course, the brand name that goes back 180 years. Wall Street Reporter, oldest financial brand in the world, besides The Economist. Maybe they're tied. The Economist, the Wall Street Journal, by the way, came later. That came in 1892, I believe. Wall Street Reporter was founded in 1843, the first financial newspaper in the United States. And we've been carrying on that tradition online since 1997. We've been probably the oldest player online. With CEO interviews, all that stuff. So look, guys, the promotion is extremely important. And if you see a stock, if you see a CEO that says they don't need promotion, or they're not really doing it the right way, if they're not on Wall Street Reporter, if they're not promoting their stock on Wall Street Reporter, then you know that these guys are amateurs. I mean, I hate to say this. I'm not trying to badmouth anybody or give you some sort of hype, but the reality is this: the guys who are smart understand the value of Wall Street Reporter. The guys who are amateurs, the guys who are clowns, are using other companies and they're not getting results. And that's why those stocks are failing. They're going nowhere, and the ones on Wall Street Reporter are actually increasing even during bear markets. Anyway, let me know what you think. Leave your comments below, and also make sure to get the book, 10 Bagger Blueprint, on Amazon. Here's to your 100x, my friends.